What if the very signals that scream optimism in the market are actually whispering a warning? We're looking at a fascinating analysis from a recent WeChat article today, and it peels back some really interesting layers of market behavior.
It really does. The article kicks off with a snapshot from July 3rd, 2025. That looks great on the surface. The QQQ was up nearly 1%. The VIX, which measures fear, was down. But the real kicker was the relative strength index, the RSI for the QQQ. It hit 71.87.
Okay, so for those of us who aren't staring at charts all day, what does an RSI of nearly 72 actually mean?
Think of it like a car's tachometer. When it gets into the red zone, it means the engine is running really hot and might need to cool down. An RSI above 70 is that red zone for a stock or index. It's a classic technical signal that it's overbought, meaning the price has gone up too fast, too soon, and might be due for a pullback. The article's advice was pretty clear. Don't open new positions. Just hold what you have and get some cash ready.
That makes sense. But what's really wild is that 2 weeks later, on July 18th, the market just kept climbing. The NASDAQ hit new all-time highs, and its RSI was still in that overbought territory.
Exactly. And that's the core tension. This persistence makes you ask, are the old rules broken? Is this some new era of permanent growth, or is this just a bigger and bigger bubble getting ready to pop?
But if the market keeps defying these overbought signals day after day, doesn't it make investors question the validity of these indicators altogether? It feels like it could lead to a dangerous complacency, where people just start ignoring the warning lights on the dashboard.
That's the psychological trap, 100%. It's classic FOMO, fear of missing out. You see the market go up, your cautious strategy of holding cash feels wrong, and you're tempted to jump in right at the top. These indicators aren't crystal balls. They're probabilistic. They signal higher risk, not certain doom. Resisting that urge to chase the rally when the signals are flashing red is what separates disciplined investing from gambling.
So, what we're seeing is a market that's constantly testing the limits of what's considered overbought, which demands both patience and preparation. This actually leads us perfectly into our next point: how specific policy shifts are creating their own unique currents in the market.
Yes, and this is a big one. The article points to a recently passed US tax bill. Now, it's not about a simple tax cut, it's about a massive reallocation of government spending. We're talking about a projected 3.25 trillion expansion to the deficit over 10 years.
And where is that money going? The article mentions cuts to things like Medicaid and clean energy, but huge increases for defense and border management.
Precisely. But the most explosive part of this bill wasn't even about the money. It was the removal of a clause that would have prohibited states from regulating AI for 10 years. The article interprets this, and I think correctly, as a massive green light for the AI industry. It's essentially the government saying, full speed ahead, especially for what it calls defense AI.
Which brings us to a company like Palantir. The article seems to have an incredibly strong conviction in them, even suggesting they could become a trillion-dollar company.
The conviction is palpable. The advice is basically to never sell on minor dips and to buy more on any significant pullback. But this is where it gets complicated. While the article is bullish, Wall Street analysts are mixed. You have some, like Wedbush, who are optimistic because of all the potential AI and defense contracts, but others look at its valuation and get nervous. We're talking a price to earnings ratio of over 500, trading at 97 times its projected 2025 earnings.
Wow, 97 times earnings. That sounds incredibly high. So how do we reconcile that tension? You have this powerful story of government spending and deregulation on one side, but a valuation that seems stretched to the limit on the other. Is this just long-term vision, or is it irrational exuberance?
It's the ultimate debate. Are you buying the company as it exists today, or are you buying the story of what it could become in a decade? The bulls will point to its expected earnings growth driven by these new contracts and say the old metrics don't apply. The bears will say that price reflects perfection and any small stumble could lead to a massive correction. It's a high-stakes bet on a very specific future.
These strategic policy shifts are clearly creating powerful tailwinds for sectors like defense AI, but they also introduce these huge questions around valuation. And that brings us to another company where the future is everything, Tesla.
Ah, Tesla, a company where the story is just as important as the product. The article raises a really interesting flag here, and it's not about car manufacturing, it's about Elon Musk's increasing political activities.
Right. It suggests that his focus on politics, maybe even forming a third party, could actually hurt shareholders. It even points to the stock's decline from late 2021 as being partly due to concerns around his focus shifting to Twitter and his controversial posts.
It's a classic case of a company's fate being tied to its charismatic but controversial leader, and the article presents a stunning breakdown of the stock price. The idea is that of say a 300 stock price, the actual core car business might only be worth 100. The other 200 is pure speculation on the future of robotaxi and the Optimus humanoid robot.
So, two-thirds of the company's value is based on products that don't meaningfully exist yet. That's a lot of faith.
It's an immense amount of faith. It forces you to ask how much of your investment is in Tesla, the car and energy company, and how much is in Elon Musk, the brand and political figure. The risk is that if his political ventures create brand damage, that 200 premium could evaporate very quickly, even if the car business is doing okay.
But if Musk's political involvement is such a clear risk, why isn't the market discounting the stock more heavily? It seems like investors are still willing to pay that premium.
Because the potential reward is just as massive as the risk. The vision of a fleet of autonomous taxis generating recurring revenue is so powerful that for many it outweighs the present day drama. The article's advice reflects this. It says to hold for the long term, but only add to your position during pullbacks caused by negative events. Is basically telling you to be a long-term believer, but a short-term opportunist.
So you have to be psychologically prepared to buy when everyone else is panicking because of a tweet or a political announcement. That's a tough game to play. Tesla really does feel like a high stakes gamble on the future, complicated by the X factor of its leadership. This actually brings us to another area where risk and reward are finely balanced: the world of advanced option strategies.
Yes, the article dives into something called synthetic long options, or SLO. It's a way to mimic owning a stock without actually buying it, using a combination of options.
And the returns it describes are mind boggling. The example given is a stock going from about 28 to 35. If you just owned the stock, you'd make a nice 24% return. But with this SLO strategy, the return was almost 200%. How is that even possible?
Leverage, pure, unadulterated leverage. The strategy involves buying one out of the money call option and selling two out of the money put options. You can often do this for almost zero initial cost. So your potential profit is calculated on a tiny or even non-existent initial investment, which makes the percentage returns look astronomical.
Okay, that 200% return sounds amazing, but I'm sensing a very big but is coming.
A massive, but the article immediately follows up with the downside scenario. If that same stock falls to 20, the stock owner loses about 29%. The SLO position, it loses 216%. You don't just lose your investment, you can lose more than double your initial non-existent cost because you are forced to buy the falling stock at a higher price.
Whoa. Can you give me a simple analogy for that? It's a bit abstract.
Okay, imagine you want to bet on a racehorse. Instead of buying the horse, you make a clever deal. You pay a tiny fee for the right to buy the horse at today's price. After the race, that's your call option. To pay for that fee, you promise two other people you'll buy their losing betting slips from them. If the horse does badly, those are your put options. If the horse wins, you exercise your right and you've made a fortune on a tiny bet. But if the horse bombs, you're now on the hook to buy two worthless betting slips at full price. You are leveraged to the moon in both directions.
That makes it crystal clear and terrifying. Given that Is this strategy really something the average retail investor should even be looking at? It sounds like you need deep pockets and nerves of steel.
You've nailed it. Brokerages classify it as a very high risk strategy for a reason. It ties up a lot of your capital as margin, and you're exposed to margin calls that can force you to sell at the worst possible time. It's a powerful tool, but in the hands of an amateur, it's like giving a stick of dynamite to a toddler.
The synthetic long options strategy is a powerful reminder that with amplified gains come equally amplified risks. This idea of understanding the deeper structures of the market is something the article explores further by contrasting the US and Chinese A-share markets.
And it uses a fantastic phrase to describe the US market: jungle law.
Jungle law. What does that mean in a market context?
It means it's an environment of ruthless competition and survival of the fittest. In the US market, there are robust mechanisms like short selling and strict standards for companies. If a company doesn't perform, if it doesn't create value for shareholders, it faces intense scrutiny and can ultimately be delisted. It's kicked out of the jungle. This process, while harsh, forces companies to constantly improve and efficiently allocates capital to the strongest players.
And the article presents this as being almost the opposite of China's A-share market. So how does the presence of something like a strong short selling mechanism contribute to this jungle law?
Short sellers are like the predators in the jungle. Their job is to hunt for weak or fraudulent companies. By betting against them, they expose flaws, drive down the price of weak companies, and contribute to more accurate pricing across the market. This pressure forces all companies to be more transparent and better governed because they know the predators are always watching. It's a crucial part of the ecosystem's health.
That's a great way to put it. The article also makes a psychological point, saying that many intelligent people get distracted by short-term gains, which prevents them from doing the deep research needed for long-term success.
Right? In a jungle environment, the winning strategy isn't to chase every little movement, it's to find a few strong animals and stick with them for the long haul. The advice is to focus your attention narrowly in Scopion, just a few companies you truly understand, but broadly in time. By doing that, you ironically step out of the most crowded, competitive part of the jungle and give yourself a better chance to thrive.
Understanding these fundamental market philosophies is key. But then the article throws a curveball and talks about a strategy that seems to embrace that short-term chase, momentum trading.
Yes, chasing gains and cutting losses. It sounds like the opposite of what a smart investor should do, but the article points to a famous 1993 study by Jagadish and Titman that showed it can actually be profitable.
How profitable?
The study sorted stocks into winners and losers based on their past 6-month performance. If you bought the winner portfolio and held it for a year, the strategy yielded an average profit of about 10% over the 25-year study period.
A 10% average profit for just buying what's already going up? Why does that work?
The core reason, according to the article, is a market inefficiency. The US market, despite its jungle law, reacts relatively slowly to new information. Good news or bad news doesn't get priced in instantly. It trickles in. This gradual price adjustment creates a trend, a momentum that these strategies can ride for a while.
Okay, so it works in the short term, but you know what I'm going to ask? What happens if you hold on for too long? The article warns that holding that same winner portfolio for 3 years actually reduces the profit significantly. Why does the magic wear off?
Because the market eventually corrects its errors. The jungle reasserts itself. Those winner stocks, pushed up by momentum, can become overvalued. The loser stocks can become oversold. Eventually, fundamental value acts like gravity. The market's efficiency kicks in, the trends reverse, and anyone who overstayed their welcome gets punished. Momentum is a profitable sprint, not a sustainable marathon.
So, this journey through market signals, policy, company risks, and trading strategies has been incredibly insightful. If we were to boil it all down, what are the core takeaways?
I think the first is definitely about discipline in the face of optimism. When those technical signals like a high RSI are flashing red, it demands caution in preparing cash, even if the party looks like it's going to last forever.
Right. And the second seems to be that while policy can create these massive opportunities like we see in defense AI with Palantir, you can't fall in love with the story. You have to constantly weigh that conviction against the hard numbers evaluation.
Exactly. And that leads to the third point, which is about the dual nature of risk. Whether it's the explosive leverage of a synthetic option or the risk tied to a single unpredictable leader like Elon Musk, you have to understand that the potential for huge returns always comes with the potential for equally huge and often hidden dangers.
Ultimately, navigating the complex currents of the financial markets is less about predicting the future with certainty and more about understanding the underlying forces at play, be it the subtle whispers of technical indicators, the seismic shifts of policy, or the often irrational exuberance of human psychology. The journey through this WeChat article reminds us that true investment mastery lies not just in identifying opportunities, but in the profound self-awareness to manage risk, cultivate patience, and maintain discipline in the face of both tempting gains and daunting losses. It's a continuous dance between conviction and caution, innovation and prudence, asking us to constantly question if we are truly seeing the market for what it is or merely what we wish it to be.